Okay, good afternoon, everybody. Bobby Piton here. Thanks for joining me. Today is August 6th. Happy Friday. Just like that, another week goes by, and I'm going to discuss two companies. Actually, one is a travel company called Expedia, and the other one is called Yelp. And I'm sure everybody's probably heard of both in some capacity, but Yelp is the one for restaurants that you kind of can look at ratings. I know they've kind of ebbed and flowed. Some people have been accused of creating false ratings, etc. But Yelp is a very interesting company. It's one that I followed for a long time. I think they're trying to find their way because other technologies are most definitely trying to replace them. I know that there's once again, other types of services, whether it be Yahoo and Google trying to do ratings. So Yelp is in a tough spot because they don't have the operating system, but it was an interesting earnings report. So I'd like to talk about those two, and then I'm going to discuss briefly the unemployment rate and how that's looking across the states. So with that, I'm going to go share my screen. All right, and so we're going to go right to here with this information. So here we are. The unemployment rate came in today, and it was better than expected. I think it came in at about 5.4% for the nation. And you can see right here that, which states are doing well. And, obviously Alabama, that's a real standout, 3.3% right out of the gate. But my home state here of Illinois is not doing so hot, 7.2%. Just like that. And then we have also California, which likes to compete for the title of the most corrupt state in the union, is 7.7%. So there we go. It's kind of interesting to see how these states are doing that are pushing these lockdowns. So obviously, California was one. We'll see what happens with this recall. Illinois now wants to have masks on children again. They're pushing for that. And let me see here, who else? Michigan's 5%. And New York, 7.7%. Pennsylvania, 6.9%. So here we are. Wow, Wisconsin's pretty strong at 3.9%. South Dakota, 2.9%. I think that looks like the low. Oh, Utah, 2.7%. So the lowest unemployment rate in the nation looks as though it's Utah. And Connecticut appears to be the highest at 7.9%. So I just wanted to hit on that because, like I said, the job numbers came out. They were better than expected. And so obviously there's a lot of concern about a slowdown, everything else. Folks, 5.4% unemployment rate is pretty darn low. What I will say is, what I do find fascinating is interest rates have fallen, as we all know, in the past couple months, and there's been less concern with regards to, there's less concern about any type of crash. The crash premium in the market has collapsed. We're seeing about the VIX. Let me take a look here. VIX is always a really good proxy.
The unemployment rate. Keep seeing all the signs of help wanted, and that there's a shortage of workers right now because of COVID. So that unemployment number, does that take into account people who have exited because they're not looking for a job, but would have been working if it wasn't for COVID?
The unemployment rate is going to look. So Nicole just asked me a question. I'll share the question that she asked. She's saying when people drop out of the workforce because they don't want to look for a job, how does that impact the unemployment rate? And well, the unemployment rate will fall. The unemployment rate is tied to people who are actively looking. So the rate will fall, just the way it's designed. Now, in terms of the participation rate, we can see unemployment. So if we just look at the unemployment rate today, and then see what the participation rate was, and see if we can see that number. We'll go to Bureau of Labor Statistics. So the labor force participation rate if it was 61.7, okay. So to your point, Nicole, if you're asking the question, and it came in, it fell 0.5% here. So the unemployed number of people is 8.7 million. Okay, so then let me see here. The temporary staff fell. Long-term decreased. Long-term unemployment, people that have been out of work for half a year or more, decreased by 560,000, but is still 2.3 million higher than February 2020. So wow, that's still pretty high. It's 3 times as high as it was. The participation rate was little changed since June of 2020. So it's been the same for basically a year, but it's still 2.7 points below the pre-pandemic level. So to your point, Nicole, if you said the participation rate should be what it was before the pandemic, then the unemployment rate would not be 5.4%. The unemployment rate would be 8.1%. So a truer unemployment rate is 8.1%. Very good. Thank you, Nicole, for bringing that out, because that's the truer reflection. And I think the fact that all this money is going out to these things, to people, and they're trying to incent people not to be working. This is why we have these distortions. But hopefully they're starting to clear themselves up. Okay, so let's go to Expedia. Expedia has been around quite a while. If I'm not mistaken, I think this thing, literally has been around for over 20 years. It's one of the first internet companies. So Expedia has been with us quite a while. And you can see that obviously in the second quarter of last year, everything collapsed, 81% decline in bookings and so forth. And the revenues, I'm still shocked that they were able to do this much in revenue during that time last year. But the revenue this year is 2.1 billion, up from 566 million a year ago. Now keep in mind, Expedia in 2019 was doing about $3 billion a quarter. It's $3 billion. So it's still a third below where it was in 2019. Ironically, the stock is over 50% higher. So even though their revenues are 30% less, the stock is 50% higher. That is pretty fascinating indeed. Once again, this is for educational purposes only. There is no, I don't have any advice one way or another. Should you buy it? Should you sell it? Should you do nothing? This is strictly for educational purposes. And so please keep that in mind. If you need to hire a professional. If you don't know how to do this stuff yourself, you can always look into us at preactiveinvestments.com, or take the time to go through the filings yourself on the SEC and do this analysis on your own with some pointers you pick up from me. And then you can always read some outstanding books. So the couple that I always recommend if you want to do your own analysis is actually one called Security Analysis. And that one is by Benjamin Graham. He's the professor who taught Warren Buffett at Columbia. That's a wonderful book, and there's a lot of really good metrics to keep track of in that book. And Intelligent Investor is another important book that you should consider reading. It's pretty painful though, folks. I'm not going to kid you. That one's a little tougher to read. It's kind of like reading a law book. But the Security Analysis will show you kind of like how-to frameworks for how to do analysis. It's about, I think it's like 500 or 600 pages long. I have it on my other bookshelf. It's not here, but otherwise I'd show you guys a copy of it. Okay, so here we go. Retail is 1.7 billion. Business to business is 300 million. Trivago, see that, folks? They bought out Trivago, maybe, unless they launched it. So even though Expedia is the one corner brand, Trivago is the one that likes to look at other competition. So it's almost like a smart router that goes out there and looks for things. So that's where that is at. You can see second quarter. Here's the cost and expenses. So selling and marketing, 1.2 billion. Indirect is 200 million. So obviously this number, direct marketing, is tied to actual sales of tickets. So if they're doing $2 billion in revenue, right, $2.1 billion in revenue, and their direct selling and marketing is costing $1 billion, that means they're at about a $1 billion, they have about a 50% gross margin. Obviously, indirect is they're trying to pick up revenue from other exchanges. So it depends on how you wanted to do it. Like in an ideal world, you want to kind of break out the revenue and tie it to the cost structure associated with that revenue. So if they break out those two, I would think indirect might be Trivago. So even though Trivago ran, shows 115 million, if they're going to outside sites to get business, that might be what they're building this up possibly. It's something that, in order to better understand that, you'd probably have to go into the 10K. It's a much longer process. It's very tough to it's very tough to just see it in the quarterly. And once again, if you go to the 10K on this company or any company for that matter, what's nice about that is it tells you all the problems, risks, opportunities that a company has. So here we go. Adjusted expenses, Expedia, excluding Trivago. Oh, so here you go, folks. I just said that this number, the indirect, was 200 million. Maybe Trivago, even though it did 100 million, those expenses would be associated with it. So then, in fact, they're probably losing like $85 million. The nice thing is they actually excluded it. So here you go. What are the expenses excluding Trivago? Look at that, 205 million, 2.033 billion minus 1.828 billion is 203 million. So it was right in line with what I thought. So they're basically labeling this indirect expense is what it sounds like, and they're tying it to Trivago because they're going outside to get the additional business. All right, so let's see here. So obviously they lost money, but their cash flow was strong. So you got to remember something about EBITDA, earnings before interest, tax, depreciation, and amortization. If a company is losing money from an accounting perspective, but they're still generating cash, because then that cash, they have a choice. If they're losing money, they may not want to spend more money replacing what they depreciated in their business, or they may not need to. And so that's why some people will look at that EBITDA number. But you have to remember something, that software becomes obsolete, hardware becomes obsolete. And so as they're doing this, you do need to be aware of what it costs to maintain the business and keep it intact. So it's a slippery slope if you go down the path where you think you should focus on EBITDA and not look at how much a company is earning as well. So the share count is up 8 million year over year. It went from 141 million to 149 million shares. Current assets. So obviously they had a huge jump in cash, 5 billion. And so we don't know how much of that is just due to the fact that they're doing more business. Here we go, because you got to remember, if their cash balances are high, you got to remember what business they're in. They're in the business of collecting cash up front and then paying it out for the various merchants. So you can see right here, the deferred merchant bookings is 8.2 billion. So obviously people have paid them, and they're expecting that they pay the merchants to make good on the tickets. And so a good way to look at this is to say, take current assets, 11.11 billion minus the current liabilities. So they happen to have net working capital that is negative. They have a negative $600 million of net working capital. So if for some reason their short-term lines of credit, became problematic, they would have serious issues if they couldn't raise the money fast enough, because they just do not have the cash, which is, I don't think that's a good idea personally, but they got to run their business the way they think is fit. So that's the deal with these guys. Okay, so now we're going to go to Yelp. And, Yelp is a funny name to say the least. So let's take a look here. On the surface, I wouldn't be surprised if Expedia is it's not having the best of days. It's down 8% today, but it's still having a decent year. It started the year at about 130. It's still up on the year. It hit a high of 188. It looks like right here around March. So 188, it's down about $40 since then. So let's look at Yelp. Yelp, I know it was up strong earlier in the day. It hit $43, and now it's only up $2.42. So it's it's kind of interesting because it gave back over half its gain on the day. The company's worth about $3 billion. So if we go to Yelp and we say, okay, let's look at Yelp. They raised their outlook. Their second quarter revenue grew 52% to 257. So obviously more people are going out to eat. That's, I think, the bulk of their revenue is, I think, dining. They did $64 million in EBITDA. Once again, so they have positive cash coming in. They never spent another penny building out their platform. They're pulling about 250 million a year if people continue to use them, and they didn't have to do anything to continue to keep their business going. So they did raise their guidance to $1 billion, so 200 to 220. So it's a little less than the 250. They actually are saying 2 to 220. So they said a buyback of up to $250 million. The company's worth $3 billion. So that's not exactly 10%, but that sounds like it's about 7.5% or so. Is $250 million. Okay, so let's take a look here. Current assets, $700 million, 689. Current liabilities, 159. Folks, they have a lot of cash. Look at that. That's a nice number. So 689 minus 159 is $530 million of net working capital. So unlike Expedia that had negative working capital that they can run into a problem, this company has a lot of extra cash. And so let's take a look here. Property and equipment, they have $92 million. Long-term liabilities, they don't have a lot of long-term liabilities. So they have accumulated losses of almost $600 million. So keep in mind, shareholders have paid in $1.4 billion. About half of the current valuation of Yelp has been paid in by stockholders, okay? Something to think about. So when you look at this, if we go to Max, you can see this thing went public in 2012, right? Thereabouts. Went to a low of 19, spiked to 100, thereabouts, 97, and then it crashed to 18 or so, and then kind of bounced back to 40, then fell back to 28 and back to 40, down to 30. Then it crashed last year to 18, and now it's at 40. So this thing has been all over the map. I think it has a love-hate relationship. I think a lot of people have been waiting for this thing to work. It hasn't worked so far, and the question is, what are they doing that will allow them to make it work? That's where the analysis comes in, folks. Is it takes it's a pretty interesting effort to look into a company like this. But I could tell you right now, they've lost almost $700 million in accumulated losses since inception. So it's been around for 9 years, and they have accumulated losses. And then their share count went up as well. So it went from 72 million to almost 79 million. So even though they have a net cash position, folks, they ended up issuing more stock. And my guess is they're probably giving it to employees. And sure enough, includes stock-based compensation as follows. $40 million of stock-based compensation in 3 months. That's unbelievable. So that's a pretty big number, $40 million. That's a huge number when they only do 257 million in revenue. So 40 million of that revenue over basically, what is that? About 12% of the revenue of the company is in stock-based compensation. Okay, and that's probably what's juicing their cash flow. So their cash flow is not as good as it looks. Sure enough, $80 million of their cash flow came from employees cashing in shares, their stock options to buy the shares. So that's what's going on with Yelp. And maybe that's why Yelp sold off shortly after hitting a high. Time will tell. I have no opinion on the stock. I'm not necessarily a buyer. I'm not a seller. I have no opinion right now. I think they're in a very difficult spot is what I would say. And so, only time will tell what happens. So with that, folks, what I would say is I hope you found it useful. If you did, feel free to share it with your friends, the link. And I guess I will see you guys all on Monday. Have an outstanding weekend, and I will talk to you soon. God bless.